Hi, Ron, and happy to have you again on my podcast. Let's talk today about family offices and your initiatives at universities. So, my first question would be there is a huge number predicted by Cerulli that by 2048 there will be more than 120 trillion in assets path towards next generation. And I want to ask how this shift influences today's family offices.
First, it's great to be here and good to see you again. It's the largest transfer of wealth in history. I mean, it's 124 trillion. It'll probably go up before the next 6 months too, but because the market keeps going up. But it's 124 trillion that's moving from the baby boomers to the next gen. So it is the largest transfer of wealth in history, and that'll fundamentally change a lot. I think that where we're at right now is the next gen. As we have the model today, the model doesn't work, and we've gone over this before. Only 25% of families make it to the second gen, 10 to the third, and 5 to the fourth. I think we're at an inflection point, and I think we're at the point where family offices are starting to reevaluate what they're doing. What happened was post-crash, pre-COVID, no matter what you invested in went up. Private equity, venture capital, real estate, Bitcoin, the stock market, interest rates are zero. And a lot of family offices did direct deals. And it worked until it didn't, when they started jacking up interest rates about 3 years ago. So now family offices are not all, but many, are not only not making money, but losing money. So then the question is, if that's the case, what do they do? Well, the issue is there really is no playbook right now. And that's one of the things we're trying to create at Booth, University of Chicago Booth, for the Family Office Initiative. And I think how this is going to play out is I believe that 85-90% of the family offices that exist shouldn't exist, objectively. They'd be better off in a multifamily office. And the 10 or 15% that should exist are going to get bigger and bigger. And they're going to be even more disruptive to the KKR and Blackstones of the world because they've got patient capital. So I think we're at an inflection point. I think family offices are going to really start evaluating what they're doing. The majority of them, in my opinion, are going to morph into the multifamily offices. The larger ones, in my opinion, are going to get larger, co-invest with other large family offices, compete head-on with the Apollos, the Blackstones, KKRs of the world, and because they've got patient capital, they've got a better model. So it's a fascinating time, and my world is changing literally in real time every day.
Okay, and you mentioned like only 25% make it to Gen 2 and 10% to Gen 3. What do you think is the biggest problem why families fail in this transition? Or like 1, 2, 3 top reasons why they fail?
It's a good question. There's many reasons why. I mean, one of it is, well, first of all, this is a new industry. Remember, 68% of the family offices that exist started since 2000 and half since 2008. So this is still a relatively new industry. And there is no playbook. So one of the reasons is there's no playbook. Second reason is people have a liquidity event. What do? They start investing. That's the last thing they should do. When you have a liquidity event, the first thing you should do, and one of the things we're trying to put together at University of Chicago Booth, at the Family Office Initiative, first thing you should do is governance. Second thing, you should have a mission statement, investment statement, next gen, succession, get your estate planning attorney and the structure wrapped up. Then you can invest. So one of the other reasons is that people all of a sudden have liquidity and they start investing from day one when they don't have their structures, like the foundation of a house. You need the foundation of a house first. And then the other thing is, I think a lot of the problem is it has to do with the ego of the founders. Not all, but many. Because you're good at something doesn't mean you're good at everything. Because you built $1 billion company, I use Ty Warner as an example. Ty Warner was a brilliant businessman. He created Beanie Babies and sold it for a couple $1 billion. Then he tried to buy the Four Seasons Hotel and got clobbered. To me, that's an example of where we're at. You've got huge amounts of capital in general, inefficient hands. Because you're good at one thing where you make your money doesn't mean you're good at investing in venture or in real estate or private equity. They're two completely different skill sets. And it's driven, in my opinion, primarily by ego. I think that's going to change too, but that's where we're at right now.
Okay, let's talk about your programs. how these initiatives with universities help professionalize and prepare future leaders for managing family offices. So if you can cover a bit about how this idea came and what's current programs are.
So about 4.5, 5 years ago, right around when COVID was starting, I put together a family office initiative at Stanford University, and I chaired the Disruptive Technology Center, the advisory board, and I said to the people at Stanford, let's put together a family office initiative, and they gave me the go-ahead to do it. And what I wanted to do initially, right now, is because a lot of the family office conferences, and they're all over the world now, these family office conferences. And a lot of the investors that I invest with, we have a syndicate of about 120 families that anywhere between 250 million to 30 billion, and we invest together in the private markets, so private equity, venture capital, real estate, sports teams, etc. And I keynote a lot of these conferences, and they always, many times, they'll ask me, should I go to this conference? And almost always I'll say no. It's a pay-to-play model. It's broken. So in other words, if you're speaking, you might be good, you might not be good, but I know you spent 25 grand and that's the only reason I'm listening to you speak. That's not a great reason to go to a conference, right? So I wanted to reverse the model. So what I did is I went to Kirkland and Ellis. Ryan Harris runs the family office practice for Kirkland, and Bobby Stover, who just retired, ran the family office practice at EY. I said, look, you guys do the heavy lifting, and what I want to do is I want to put together a conference that I would tell you to go, that I would tell my investors who invest with me that they should go to. So I'll give you 3 quick examples. This is during COVID. First guy I called was Paul Carbone, who's a close friend. Paul runs the family office for Tony and JB Pritzker. He wasn't pitching a fund. He wasn't selling anything. He just said, this is the funnel. We start with 200 companies. It goes to 100, it goes to 50, it goes to 20. At 20, I come in. Then we have an investment committee meeting. Then we decide if we want a board seat or not. Again, pure education, no agenda. Second example, Tim Callahan. Tim was Sam Zell's partner. He wasn't raising Fund 4 or Fund 5. He made a fortune in offices. He was simply opining on what he thought was going to happen to the office market. Because remember, during COVID, we didn't know if people would ever go back to offices, or if they did, how that would look. No agenda, just educating, giving his opinion. And by the way, he was pretty much spot on everything he said. Last example, Denise Illich. Denise, they own Little Caesars and a couple sports teams in Detroit. She, along with Dan Gilbert, her family helped to rebuild Detroit. She wasn't asking for people on the call to donate to her philanthropy to make Detroit better. She's just saying, look, here's what we did. If you want to be philanthropic, whatever it is, you need to run it more like a business. And this is what we got wrong, and this is what we got right. Again, no agenda other than to educate. We had 880 families from 6 continents on a Zoom call during COVID, 420 over $1 billion. So that was a check the box. I then realized that, in my opinion, that you've got huge amounts of capital coming in very fast right now. It doesn't take 2 generations to create wealth. Because of the internet and because of AI, you can now create wealth with an app, literally almost overnight. So and these conferences don't do it. So I thought when I did the conference at Stanford, I realized we were onto something. Now I live in Chicago, and University of Chicago Booth is probably the top business school, well, in the country, or you could argue in the world. So I was having lunch with Michael Milken, who was my first boss, and Steve Kaplan, who was the top professor at Booth, and we talked about it. And Steve said, well, actually, Paul Carbone also talked to me, and he said he wanted to do it. So this was 3 years ago, and we said, let's do it. So we whiteboarded it. And what we're doing and what we did, and the reason we're doing this, is the first thing we did is we put together a course. Now, today, the top kids out of Booth or Wharton or Stanford or Kellogg or you name the top business school, what do they want to do? They want to get into private equity, venture capital, real estate, hedge fund, etc. Very few want to get into family offices. Very few know what a family office is. With $124 trillion being transferred from baby boomers to the next gen in the next 20 years, it's my belief, and I could be wrong time-wise, but I'm right directionally, that at some point, it could be 3 years, 5 years, 7 years, working for a family office would be the first choice of these kids out of these top business schools. So the first thing we did is we put together a course, and we didn't know how it would do. We put together a half a credit course because we thought it would do well, but it had never been done before. It's the first one that ever happened. Specific class specifically for family offices. It sold out quicker than the private equity class. We had 65 students sign up immediately. I taught, and it was a half a credit course. I taught one of the classes, and what was interesting is I gave my email to the students, and if you want to reach out or you have any questions, just call. 48 out of 65 reached out to me, not for a job, but just asking questions. Like, I got a job at a private equity firm. Is it too early to go to a family office? Or all kinds of, but there's huge demand and huge interest. So that class worked, and we got great reviews for the course. Professor Heaton was the main teacher. I just taught one of the classes. And now we're going to do a full credit course because it did well. And then we had a conference that's there. And the conference was last May, and we're going to have a second one this coming up May. And we limited it to 175 students. 175 family offices, $1 billion or more AUM. That we kind of wanted to cut it off at a certain level. And the people who spoke were Nobel Prize winners from Booth, talking about tariffs or talking about interest rates or talking about the economy. No agenda, just education. And the beauty is we don't have to make money because we're at the university level. Tony Pritzker donated $5 million for the naming rights of the professorship, and then we've got somebody else who's donating $30 million for it'll be the X Family Office Initiative at Booth. So we don't have to worry about what other conferences have to worry. So as a result of that, we don't have to get sponsors to pay for it. As a result of that, we can educate, and that's what we're going to do. So it's changed everything. And then we put together, the last thing is we put together an advisory board, Family Office Council, of about 50 family offices. These are families all mostly over $5 billion, the biggest families in the world. And they're on the advisory board. So it's a process. We're learning. It's fluid, but it's making a huge impact. And once I announced what I'm doing at Booth with Paul and with Steve Kaplan and the other people, I had about 6 other universities, top universities, reach out, and they want to do the same thing. So in 5 years, I think this is going to be commonplace, and that's fine because we don't compete with them. Everyone will have their own lane, but I think in 5 years, almost every major university, the top business schools, will have family office initiatives.
How long is it for students? How many lectures, or how is the program formed? What are the key ideas you teach there?
Well, the program itself was initially a half a credit course, and now it's a full credit course. So I think it'll be like 9 or 10 classes. They meet once a week. I think they're 3-hour classes. It's a full credit, like you're doing any other course. And again, we're trying to educate them. The next generation is going to inherit $124 trillion, and right now we want to prepare them to do it. And what I want to do is change the numbers where right now if only 25% make it to G2, 10 to G3, and 5 to G4, we have to change that because the model doesn't work. Part of what we're doing there is teaching these students the advantages of patient capital, teaching them different things with investments, with how to run businesses more, or how to run philanthropy more like a business. So there's a lot we have to do, but it's exciting, and the students were extraordinarily energized.
What are the typical difficulties when the transfer is happening, when a new family member starts managing the family office?
Right. We'll start with the premise. First of all, there's no typical family office. They're all different. Everyone's got their own idiosyncrasies, and everything's a little bit different with each family office. But in general, I think what's going to happen is there is no place. What's happening is the amount of wealth that's been created and being transferred is unprecedented. And as soon as people have liquidity events, instinctively, they just start investing. And it's not irrational. You all of a sudden have a lot of money. Why shouldn't you invest that money? Because you're not just going to sit with it in cash. But people are realizing that things like governance, things like succession, things like next gen, things like educating the next generation for families, philanthropy, estate planning, these are all things that have to come before you start the investing. So what happens is it's almost done backwards. They start investing, and again, intuitively it makes sense. I've got a lot of money now. I sold my company for $1 billion. I'm not going to sit in cash. I'm going to start investing, and my friend's got a good private equity fund, and this guy's got a great real estate firm, and this guy's got a great hedge fund. I'll invest $5 million in each of them. Intuitively it makes sense. But when you look at it in totality, it doesn't, because you really have to have the structure. So there's something called structural alpha, and I think structural alpha is going to be a term that's going to be used more and more going forward. And it's almost like you've got to build the foundation of a house first, before you build the house. The basement's the boring stuff. Governance is not fun. Talking to an estate planning attorney, some people might like it, but typically not fun. Succession, next gen, a mission statement, all that stuff. But this is the playbook you need. And this is part of the reason why the model only 25% make it to the second gen. I think our goal is to change that. I don't think we're going to transform it overnight, but if we can get it from 25% to 50%, that's a big change. And that's what we're trying to do. So the answer to your long answer to your question is we're putting together a playbook where once you've had a liquidity event, or once you've inherited the money from your mother or father or grandparents, you should do A, then B, then C, then D, then E. That does not exist today.
So I recently came across one study by PwC that one picture caught my attention, where it said that like the majority of family offices actually start actively investing not after some exit, and like but having the company and generating profits from this company forms a family office more often than a liquidity event. It's interesting, like whether you got some of the statistics or examples on how typically someone decides to form a family office.
So to answer your question, first of all, yes, there are companies that have operating businesses. Some of the family offices still have operating businesses. Many of them do. And they have to start a family office. But with the amount of wealth that's being transferred, the majority of these family offices are being started with money that's being inherited, right? So that's number one. And the other thing is, with a playbook, you sell your company, you sell your widget company for $50 million or $100 million. That's a ton of money. It's just not enough to have a family office. And if you do the math, if you're going to invest in the private market, particularly if you're going to do direct deals, you really need a minimum of about $500 million to have it make economic sense. Otherwise, you're better off going to a multifamily office, where rather than paying for your own accountant, your own admin, your own attorney, your own staff, you share it with 10, 20, 30, 40 families. That's what a multifamily office is. And so the multifamily offices in general, between 10 million to 500 million, that's kind of their sweet spot. Once you get to 500 million, and you still may go to a multifamily office if you don't want to do this a full-time thing. But the other problem is that right now, a lot of people, they have a liquidity event, and then they kind of take their, they feel great and they take their foot off the pedal and they're like, okay, now I'm going to start a family office. Well, that's the wrong mindset. If you're going to do this half-ass and you're not going to have as much attention to the business as you did in your actual business, you shouldn't have a family office. You should just have somebody else, a multifamily office, manage the money. Having said that, if you're committed to do it and you realize this is now another business and I'm going to treat this like a business, then it makes sense if you have enough money to do it. If you're going to work full time and if you're going to treat this as a business, and you will understand why you're trying to create a family office. I mean, a lot of people, they create a family office because that's what there's, that's right now it's like a buzzword. That's what you have a certain amount of money, you create a family office for what purpose? Now, there are some great purposes to have it, and there's some not great purposes. And I don't judge anybody for anything, but I think that you really need to think it through. Is this something, I just sold my company, do I still want to be fully engaged and hire people and pay people and run another business? Because a family office, if you don't treat it like a business, it's going to fail. And that's another problem with family offices.
Mm-hmm. Okay. I'm also thinking about someone who considers an alternative. Okay, I don't need a family office. I can just put my money in S&P 500 or some other ETFs or indexes. And do you think this strategy might work for the majority of people who have big wealth?
Yes, I do. I think putting money in different indices, yeah, I think in many instances, if you're not of the expertise of the staff, it makes sense. Now, you're not doing it on a day-to-day basis, so some people feel like, well, it's passive, but you put your money in the S&P or several different indices, you've performed much better over the past 20 years than most of these people who spent all this time, effort, and money investing in these things. So in many instances, it makes sense. One of the things that you're going to start seeing more of is what I'll call tax-aware investing. So there's a firm, AQR, which manages, I think, $185 billion. And they're literally growing at $3 billion a month. And the reason is it's tax-aware investing. If Citadel's up 20%, that makes zero difference to me. All I care about is that after tax, they're up 12% or 13% or whatever that number is. What happens is you've got the accountants in one room, the lawyers in one room, the CIOs in another room, and they don't communicate. And without communicating, they're not doing it efficiently. So again, this falls under the auspices of structural alpha. I think what you're going to see is tax-aware investing is going to become much more commonplace. Right now, private credit's a perfect example. Private credit is a popular asset class. After pre-tax, if you get 10 to 12% pre-tax, it's fairly conservative if you get in the right one. And 10 to 12% is a really good return. What people don't realize is if you're in California or New York, that 10 to 12% might be 5 or 6 or 7% after tax. So you could structure it with a PPLI, private placement life insurance policy, as a wrapper, and you basically pay 50 bips and get rid of the income taxes. But just structuring things like that, people look at, I'm getting 10 to 12%. You're not. You live in California, you're getting 5 to 6% or 7%. That's what people have to look at, and that's what people have to focus on. The only thing that matters is after-tax return, and I think you're going to see family offices focusing on that a lot more.
Okay, yeah, agree.
And you're also seeing it with ETFs. I mean, I just helped to put together a conference with McDermott, Will and Emery, and AQR on just tax-aware investing, and they invited like 70 family offices, multi-billion-dollar families. And the interest was overwhelming because right now, tax-aware investing is where people are focusing right now. And right now, in some family offices, the CIO is paid pre-tax, which makes absolutely no sense whatsoever. They're better off being paid after tax, so their incentives are aligned. So we also have to get the alignment of interest in place, and that's something else we're trying to do.
Okay, understood. Yeah, the question is what G1 must do today to preserve their capital and build a long-term strategy in order to reach generation fourth and further.
It has to do with what I talked about with the playbook. The first thing you need to do is, most people when they have a liquidity event and they start investing, I use the word, say, governance. They don't even know what governance is. Without the proper governance, it's going to fall apart, right? And then you need to figure out a mission statement. Like, what are you creating this for? And then you need to have an investment policy statement. So is the family office for wealth preservation? You've got $1 billion. It's more money than your great grandkids will ever need. Am I just trying to preserve it? Or I've got $1 billion. I want to grow it to $3 billion, and I want to be proactive with it. And that's the way you are. And there's no right or wrong answer, but you have to figure that out before you do it. Because if you don't have that figured out, you're not sure if you're wealth preservation or you're trying to be aggressive and grow, it makes no sense. So you've got to get your ducks in a row. And I think that by doing this, by putting together the investment policy statement, by putting together the mission statement, by dealing with the estate planning attorney and structuring everything right, that gives you your best chance. And then investing, that gives you your best chance for long-term success. If you just start investing and forget the other stuff, the statistics won't change.
What are the best sources to learn about family offices? What do you read? What books you recommend? Or if someone wants to go into the family office space, where they should start from? Of course, subscribe to Ron Diamond on LinkedIn.
I'm just trying to be a funnel where people can understand this better, because it's just such a massive industry. I'm just trying to bring it together a little closer and make a little dent in it. I mean, there are very few good books. The best book out there is probably by a good friend of mine, Bill Woodson, and Eddie Marshall. Wrote a book on family offices, and that's the best book that I know of. But you're not going to, learn everything just from reading a book, but that's good. I think the best way to do it is, and what I tell people who've had a liquidity event, is really just talk to other families, because you can see what they did right, but more importantly, you can see what they got wrong. So there are so many unintended consequences. There's a family we work with where there was a sudden death, and then all of a sudden there are a whole bunch of unintended consequences, which they had estate planning things worked out, but because of the death, and it was sudden, there were a lot of unintended consequences. You need to plan for things like that. The best advice I can give to any family office is talk to other family offices, see what they got right, which is good, but more importantly, see what they got wrong. And they're happy to share with you.
Okay. Yeah, super. Thanks so much, Ronald.
Okay, thank you for having me.